I would like to welcome everyone to our presentation today. Thank you for attending our webinar. It's an Ask an Expert series with the County of Simcoe on how to properly value or determine the value of a business. We are recording this session now, so please be advised that any questions that you pose and any questions that you put in the chat will be part of that recording, and the recording link will be available following the presentation. My name is Carol Benedetti. I'm the Community Development Coordinator for the CDC, the Orillia Area CDC, and I am very pleased to be your moderator for this session. I'd like to start with a land acknowledgement, as we are co-hosting this event with the County of Simcoe through the Orillia Area CDC. I want to begin by acknowledging that we are situated on the traditional land of the Anishinaabe people. We acknowledge the enduring presence of the First Nation, Métis and Inuit people on this land, and we are committed to moving forward in the spirit of reconciliation and respect. The Planning Committee and the Ask an Expert series is led by the County of Simcoe, and over the last 2 years, they and we have been able to bring you many excellent presentations and help you navigate the current business environment. I encourage you to keep an eye out for future webinars. And I also want to just take a brief moment to acknowledge our partners, the Small Business Center of Barrie, Simcoe County and Orillia, South Georgian Bay Small Business Enterprise Center, Orillia Area CDC, that's us, Nottawasaga Futures, North Simcoe Community Futures Development Corporation, Community Futures South Georgian Bay, Sandbox Center, and the Henry Bernick Center for Entrepreneurship at Georgian College. Prior to today, many of you shared questions. And actually, we got a lot of great questions ahead of time. So we are going to try to keep the questions to the end of the presentation, but we encourage you to put them in the chat, and we'll try to get a really good cross-section of the questions posed to our expert. And hopefully, if there are any other questions following that weren't answered, we can address those following the presentation. So I would like to take a moment to introduce our presenter. David Holmes is a chartered professional accountant, chartered business valuator, and is certified in financial forensics with over 20 years of valuation, finance, and accounting experience working with organizations that have ranged from large publicly listed companies to smaller owned managed entities. David is the past academic advisor to the Canadian Institute of Chartered Business Valuators and York University, where he was responsible for overseeing the CICBV's program of studies. David is a partner at Rumley Holmes LLP, a professional services firm with over 20 professionals, where he advises business owners on valuations, the purchase and sale of businesses, and tax minimization strategies. So I think at this point, I will turn it over to David and we'll start our presentation. Thank you very much.
Okay, thank you very much, Carol. And thank you everybody for joining today. And I hope you find this presentation useful and you get something from it. So just bear with me while I share my screen here. Okay, so I will, like I said, Carol, you can jump in case, if I do have any problems with my audio or anything to do with the slide deck, that sort of thing. So yeah, so welcome again, thanks for joining. Today, we're sort of going to be concentrating on the concept of how to value a business, but we'll also go over some items such as how to prepare your business for sale, tips for maximizing value, and some tax minimization strategies. So to sort of jump right in, the genesis of business valuation is that you are trying to determine what the present value of the future cash flows of that business are worth. And that goes to whatever methodology you use, it should arrive at the same result. Like they should all relatively converge in the same place, being that you can value a business in a multiple of ways, but it should all come out to the same methodology at the end of the day. Thing is, each business may have a different methodology that is appropriate for it or more appropriate for it based on the dynamics of the business, its cash flows and all that other stuff. But at the end of the day, you're just trying to measure sort of the present value, the cash flows. So this slide that we have before us now is just showing that there's sort of three main approaches: the income approach, the asset approach, and the market approach. And I'll sort of go over those briefly. The asset approach being some businesses, there are businesses out there that don't necessarily have a value in excess of the assets that are employed to operate it, being that they are just worth the book value. An excellent, or one example of that is, say, a medical doctor's practice is generally, and not always, but generally just worth the assets of the business. The reason for that is because there is no market for that business greater than the assets. Being, if you are a doctor and you decide to start a family practice, you open up, and you put out your shingle to say you're open for business, and generally, in today's environment at least, your practice is full within a few weeks or months or however long it takes to onboard the client, being that there's no reason to say buy another doctor's customer list and all the rest of it. So that's just an example of where the asset approach is appropriate. That sometimes applies to, say, lawyers as well, and sometimes contractors. There's various businesses that asset approach is the correct way to go. The other two approaches, say the market and income approaches, are similar in the respect that they are, again, trying to measure more accurately the present value of those future cash flows. Being that the market approach is where you're looking to different transactions in the marketplace. So if you owned a, say, Subway franchise, then you're going to try and find other Subway franchises that have sold and look at the approach and the multiples and all that other stuff that those franchises sold for. And that is sort of using the market approach. You're saying, I have a Subway franchise here, and here's 4 comparable transactions, and you're trying to adjust those comparable transactions to determine what yours is worth. That's generally also the sort of a key metric when you're trying to appraise or assess the value of your home. You look at your home, and then you look at what have the neighbors sold for. Their house might be bigger or smaller, has a better yard, might have been updated. Yours is more updated, finished basement. You're doing that same approach. You're taking your house, and to measure its worth, you're looking to the market of those transactions around you. And then we have the income approach, where that is sort of trying to either discount the future cash flows of the business adjusted for the risk that they will occur, or you're capitalizing the current earnings. And that's when you hear things that are like a price earnings multiple, EBITDA multiple, that sort of thing. Those are sort of income approaches. Often the income and market approaches share a lot of similar dynamics, being that you're just trying to measure, again, what those earnings are, the risk, and that sort of thing. And I'll get into that a bit more. So primarily today, we're just going to focus on the income approach, being that if you're using an asset approach, it isn't too complex. That's a business where more or less you're just winding up the business, paying off your debts, your liabilities, and then you take the assets of the business, and that's what you're left with, and whatever. So it doesn't, it's not a very technical exercise. Bear with me for a second. Okay, so yeah, we're just going to sort of generally focus on the income approach. And so the two key methodologies under the income approach are the capitalized earnings or cash flow methodology and the discounted cash flow methodology. In general, with small to mid-sized businesses, in my experience, 80% of the valuations that I do are using a capitalized earnings or cash flow approach versus a discounted cash flow approach. The discounted cash flow approach is, in theory, the purest way to value a business, most accurate, all that other stuff. However, in this sort of small, mid-sized business segment, not many businesses have accurate projections of their future cash flows going out 3, 5, 10 years. Versus a public company, a larger or public company, those companies have sophisticated finance departments. Their business is generally more diversified than a smaller business, so their future cash flows are somewhat more predictable than smaller and mid-sized businesses. And like at the end of the day, the capitalized earning cash flow is a very intuitive methodology, and it's using actual data versus sort of projections about what the business will do, which sort of at times can create additional uncertainty. So when determining a business's value and what your business valuations are worth, or what your business is worth, it generally distills down to three key concepts. So business valuations can get very complex and all that, but it all really distills down to these three things, which are: one, what are the earnings or free cash flow of the business? What is the appropriate multiple to apply to that business? And what balance sheet adjustments are necessary? And again, this all gets to what is the present value of the risk-adjusted future cash flows of the business. And so we're going to go into just sort of how you determine what the appropriate free cash flow or earnings of a business are, how you determine and the approach to finding the appropriate multiple. And then again, we'll sort of go into what I mean by the balance sheet adjustments. So the first thing is, when you take a business, and especially private small to mid-sized businesses, your reported earnings are not always reflective of what the economic earnings that will be expected to accrue to a future potential purchaser. And the reason is that in a small mid-sized business with one owner, they can make a lot of discretionary expense items that are not going to be reflective of what that potential purchaser will own. So the classic things to adjust for in a business valuation is that you add back any wages paid to owners and their related parties, and then you deduct an economic rate for the services provided. Just being in a business, for various reasons, you could have an owner who pays himself $1 a year or $1 million a year, but that's not reflective of what someone should expect to operate that business. So that's where we add that back, so that you show the business before the owner compensation, and then we deduct what an economic or market rate is for that service they provide. And you might be asking, okay, how do you determine what that is? Well, there's a number of various ways to assess the market rate, either through online job postings. There's various databases like PayScale and that sort of thing. Here at our firm, we have access to a sort of a salary assessor, where we can pluck in a number of factors such as the industry, size of the business, position, various responsibilities, and it actually gives us a market rate assessment for that position. The other thing is any non-arm's length transactions. So something that occurs very frequently is that you have a business that operates from a property that is owned by a related party or the business owner, or is sometimes owned by the actual business itself. But the real estate is a separate asset and subject to separate risk profiles and a different valuation in general. So therefore, in that case, you sort of, again, add back the rent paid to that related party, say it was a side holding company, and you deduct the market rate for that rent. And that's fairly easy to, you can, sometimes when these things are taking place, the property is appraised by a professional appraiser. I don't actually do any real estate appraisals. I just do business appraisals. And then you deduct that market rate of rent either through an appraisal. You can also just look up on realtor.ca or MLS, and you can find often similar properties for rent, and you just deduct that market rate of rent. The other thing that you want to do is you want to adjust those earnings for significant one-time events. Those can be both revenue and expenses. So you could have a business and you're looking at the historical 5 years and you're really trying to determine what those earnings will be going forward. And I guess just to step back there a bit, that is sort of what the process of normalizing cash flow and earnings is, to determine what that business is most likely to earn going forward to that potential purchaser. And so the one-time events could be in a given year. the company may have made a large expenditure for a piece of equipment, for a new IT system. It may have had an incident where there was a flood in the premises and they had to spend money repairing or buying new desks, furniture, anything like that. So you need to make sure you normalize for those one-time events. The same thing could be on the revenue side. You could have a business that obtained a one-time contract to supply, an X number of widgets that will not reoccur, and it was outside of the normal scope of operations. Recent examples I've had with that are, say, I was doing some work for a company that was in Vancouver around the Olympics, and they had a one-time surplus due to those extra revenues generated by the Olympics. That would not be a revenue item that's expected to occur in the future. Therefore, you normalize for it. The other thing that you want to adjust for is any discretionary or personal amounts. Often cases there in the company, it pays for life insurance policies for the shareholders, vehicles, and other amounts, which are very standard and legitimate. However, you need to make sure those are sort of reflective of economic cost. Most, if the company does pay for a shareholder or related party's life insurance policy, that is not needed to operate the business, generally speaking, but 90+% of the time it is not. So that's something that you adjust for. Same with vehicle expenses. Oftentimes, vehicle expenses are greater than what is actually required. The key metric there is just to sort of add back all the vehicle expenses for shareholders and related parties and look at what your per kilometer cost is at a CRA rate, as that's what you would actually pay an employee or someone else doing work for you. The other time is sometimes there's personal amounts, vacations, other things. I've seen, been doing this for a long time, so I've seen a wide variety of sort of personal amounts going through the financial statements. My advice there is, if you are looking to sell your business in the coming years, to generally have cleaner books, as that makes the process easier. The more adjustments you may have for certain things like that, then the higher risk it becomes to that potential buyer. Because if you have a business and just say you're showing very little or minimal income because there's a bunch of personal items, and then you have to go back and normalize for these 15 items, that creates uncertainty to the purchaser to an extent. Are those real numbers? Is that not? In general speaking, the less personal items, in my mind, the better. And as it just creates less uncertainty for that purchaser. The other thing is that those personal items do create a potential liability to both the business seller and the purchaser going forward. Okay, so that's earnings. Again, the purpose of normalizing earnings are to try and estimate what that new owner is going to earn from the business going forward. The other concept to remember in this is you are selling and or buying the business that it is, not the business that it will become. There are times where you can get a premium for a business due to a growth profile. Maybe certain things are happening that business is going to grow, and you can at times capitalize on that. The only thing where I sometimes see this is where someone says, well, I'm not, working that hard in the business. I've stopped, pursuing new business, but the new owner will be able to earn twice as much as I do. Well, that's all fine. And we'll sort of get to that later on, when sort of just tips of selling a business and getting ready to transition it. But you cannot capitalize on someone else's future efforts, in general. Being that, if I'm going to buy a business and the owner says to me, oh, but if you just go do these 3 things, you can double the business. Well, why am I going to pay the seller for that when that's going to be my own efforts, right? So just that's one thing to keep in mind. You're selling the business. It is not what it will become. Okay, the next aspect, so we talked about earnings, again, trying to estimate the earnings that will accrue to a potential purchaser. The next thing is the multiple. And so again, if there's sort of concepts of earnings multiple and discount rates. A discount rate is the inverse of the multiple, being that if you have a 10 times multiple, your discount rate is 1 divided by 10, or 10%. We're just going to talk about multiples because I think that's more intuitive. If you think about a multiple as a lower multiple is a higher risk, lower value business. A higher multiple is a higher value, lower risk business. Because at the end of the day, the multiple, what you're trying to do in applying a multiple or discount rate to a business is you're assessing the risk of that business. And it's the risk of those future cash flows reoccurring. And, you know, like a primary example, just to talk discount rates for a second, is like a government bond. You know, you can buy a 5-year or 10-year government bond and it pays you whatever it is these days, like around 3 to 5%. And that is a relatively low rate of return because all things being equal, the government is unlikely to default on that debt and you can count on that cash flow stream. To get to the business side, the businesses that have the greatest multiples and have the greatest value are those where the customers are very sticky and the future revenues are very secure. And so that's where you have contracted clients and they are obligated to continue purchasing from you from a period of time. That creates security to a potential purchaser. Because if I'm buying a business that has $100 of revenue and 70% of it is guaranteed by future contracts, I am certain that those cash flows are going to reoccur. Therefore, I'm willing to pay a higher multiple and it is a greater value business versus a business where, say, the clientele is one-off and unlikely to repeat and has no contractual obligations. The certainty of that business reoccurring is greater and therefore the value is lower.
David?
Yes.
I've just had a question, if it's possible for you to turn your camera on so we can just see your face while you're presenting?
It is on. I feel like it might be on. Hold on. Okay.
I can see you now.
Okay, let me just get back to the other screen. Okay, do I appear on your screen? Because I'm just seeing you at the moment, Carol. Oh, Carol, I think you went on to mute.
This is the part we edit out in the recording.
All right.
Okay, let's just proceed.
Yeah, this is, oh, sorry, let me just try something here. Okay. Yeah, I don't understand why I can. Okay, well, I'll pop on after if I can't be seen there. I'm just, yeah. Just trying to figure it. Okay, so yeah, so the next question is, you know, how do you determine a multiple? That's a lot of, you know, determining the correct multiple or discount rate to apply is generally the most subjective aspect of business valuations. But also to go through how you kind of the sort of thought process and determining what multiple is appropriate, why you would apply a 3 times multiple one business and a 10 times multiple to another business. So the first, you know, like as I was sort of what I've been sort of saying here is the uncertainty regarding the company's ability to realize the level of indicated maintainable or future cash flows. That's ultimately sort of, you know, the risk you're trying to ascertain. Again, looking at, you know, there's a multitude of dynamics. How sticky are those customers, the reoccurrence, how often do they come back? Is it all one time? The degree of word of mouth referrals, who your referral sources are. Some businesses may not have reoccurring actual customers, but they may have 5 referral sources that refer in business constantly. So even though the customers themselves are not reoccurring, the referral sources are and can be potentially transferred. That's the other aspect, is to concentrate. You have to know that do those earnings transfer to the potential purchaser? So then we look at so this is where I say sort of the income and the market approach blend in together a little bit. Earnings multiples considered both appropriate for both similar and dissimilar businesses. So we look at multiples across the spectrum. Those for very similar businesses, that's the sort of, you know, there are, you know, say a McDonald's franchise, right? There will become a pretty formulaic approach for what multiple a McDonald's franchise sells for, because they're all relatively the same. You're of course going to adjust that for population base, geography, all the rest of it. There'll be sort of some ups and downs, but you compare that your business to other transactions. You also look to dissimilar businesses, because even though the business may be not the same, it may share certain attributes, or you're also just looking for context as far as just the overall environment for multiples for businesses. The competitive market and the subject company's position therein. So you look at those aspects. Where does it sit in the competitive market? Some businesses are highly competitive, pushing down prices, pushing down margins, therefore generally lower value, whereas some businesses, there may not be a lot of competition. If you don't have competition, then you can have higher margins and you are generally more profitable and you are less susceptible to those earnings reoccurring, right? Because like if we look at that earnings, again, trying to assess the ability of that potential purchaser to come in and enjoy those same earnings and cash flow as the existing owner did. If it's highly competitive, it could be when it transitions that those sales go away. In a non-competitive industry, then it definitely, there's greater chance that they will reoccur. We look at strengths, weaknesses, opportunities, threats, SWOT analysis. Strengths being those internal things that make people choose a given business versus a competitor. Weaknesses, again, internal. Those strengths, weaknesses are sort of those internal pros and cons of the business. Opportunities and threats are those external. The tangible asset backing of a business. So what that is what the actual hard assets of the business are. In general, the greater the tangible asset backing or hard assets, the greater the value, the lower the less. Just intuitively, if you think of that, if you have a manufacturing business that has $1 million of equipment, that is sort of the downside protection to that potential purchaser. If things don't go well, they can still liquidate that equipment and recoup some of their investment, versus a business that is, say, an online retailer with no assets. There's greater risk and less sort of downside protection, right? So it just goes in the inverse. Risk-free rates prevailing on or before the valuation date. That just means, like, at the end of the day, when you're looking at a business, and that's why, if you've been paying attention to the markets, the economic conditions have been in turmoil, that sort of thing. And then if you follow markets, that, certain stocks like a Tesla, Netflix, over this COVID pandemic period have gone up in value incredibly. And then they've also come back down. And why is that? It's because the interest rate, which is the risk-free rate. You're basically, a risk-free rate is your interest rate on a government or risk-free asset. Generally, the government bonds and that sort of thing are considered risk-free. So as those interest rates come down, the rate of return increases, just like houses. At the end of the day, when the interest rates come down, the value goes up because people can pay more for those houses. And so it has the same effect on business valuation, both up and down. Industry conditions and those of the general economy. Again, you got to assess, what are those industry conditions? Is it facing headwinds? Is it, when you're selling, is it likely to continue in its trajectory? Are the industry conditions expected to improve? Are they expected to come down? Those are all things that then affect the potential cash flows of the business. Porter's 5 forces. You can Google that one to look up. I forget what those exactly are, what the ones are. The one that is most commonly referenced in the context of small mid-sized business are barriers to entry. So that being, how easy is it for a competitor to set up a business? Because, if I just use like a general contractor as an example, that is a business generally does not have a lot of tangible asset backing or barriers to entry. Again, with all these things, I speak in generalities, right? There are each situation is different. There's always exceptions. But if you look at a general contractor, has truck, trailer, equipment, construction, all that sort of stuff, doesn't have a huge value. And that goes to sort of what impediments they sometimes have to getting say a goodwill value or a larger value. It's because another contractor will look at their business and say, I can either buy theirs or I can just go start my own. And when all is needed is a truck, trailer, equipment, it's not a huge capital investment to go in. Furthermore, there's no, other things that can create barriers to entry, government licensing, any sort of, specialty trade contractor, that sort of thing creates barriers to entry. Say a general contractor versus an HVAC contractor. HVAC needs to have certain employees that have certifications, all that other stuff. Electricians, another good example. Okay, so those are the type of things that we assess. Again, you're doing sort of a common sense, looking at these items. We even have like sliding scale that sort of weight some of these different inputs and that sort of thing, and then looking to other transactions in the marketplace to determine what the appropriate multiple is. Okay, and the one thing I don't have a slide on is just sort of balance sheet adjustments. So we've talked about determining the earnings. We've talked about how the sort of thought process and go through to get to an appropriate multiple. And the last thing is balance sheet adjustments. And so what we mean by balance sheet adjustments is that a business will generally trade with a certain amount of assets and at times working capital. Generally, most of the time with working capital. Working capital is items like receivables, inventory, at times cash, less payables. So current assets minus current liabilities is kind of the definition of working capital. And we adjust that balance sheet to what is the normalized state of a business. Being that if you had a company and it has $1 million in cash, you're not going to sell it with $1 million. You're going to strip out that cash before it gets sold. And this is one of the hardest aspects just to sort of wrap your head around, especially without some working examples. But in essence, when you look at a business, you have to look at, say, your earnings are $100, your multiple is 5, so you, in theory, have a business worth $500. Then it's just identifying what that $500 includes. In general term, it would be like, okay, there's $100 of equipment, there's $50 of working capital, and there's 300, and then that difference between that 100 equipment, 50 working capital to get to the 500 is your goodwill or intangible value. That's what we'll call the value of those customer relationships, the customer list. It's all those things you can't see and touch and actually, physically count. So when selling a business, you have to sort of determine what that sort of normalized balance sheet is like to then sort of ascertain, what you're selling. And again, it is a complex part of business valuations because I compare it to real estate. Real estate, you're looking at buying a house or a piece of property. You can look to the survey. It shows you the property borders. You can have that survey verified. You can go and touch and knock on the house, have it inspected and all that other stuff. It is just a tangible asset, 100% tangible with an easy boundary drawn around it. Businesses are much more of an enigma. Their balance sheets are always changing over time. So as it's receiving cash, paying bills, that sort of stuff. So that's where, when a business is sold, it's usually, you say they're going to pay $500. It's going to come with $100 of equipment, $50 of working capital to get to that $500. And then there's usually adjustments that are made on close. Generally regarding that working capital, because you'll say, I agree to buy the business with $50 of working capital. If it has $100, then most of the times we just try and strip out, we sort of hit that working capital amount, and then we strip out any excess just before the sale. But if it does go with extra working capital, then usually the purchase price is just adjusted dollar for dollar for that sort of thing. Okay, so the next part of this is sort of preparing your business for sale. And question is, plan ahead is the key. The question is like, when is the right time to start thinking about selling your business? The best answer for that is the day you start your business is when you should be thinking about how to position it for sale, what those potential purchasers will be looking for, and all the rest of it. Like, you want to start planning ahead as much in as far ahead as possible. Yeah, because that's ultimately your goal, is to be able to capitalize at the end of the day, going into retirement. So the sooner you start thinking about that and planning that, the better. Also, sometimes they can take a while to find the right purchaser. Some businesses, it might be very easy, and that could be accomplished in 6 months, a year. Other businesses will take 2 or 3 years. The other thing is, you want to start planning. You want to start getting all your documentation in order, all that sort of stuff. And if you're not properly planned, then you might end up selling for a less than ideal price than you otherwise would have received. Same with timing. If you're in a position where you need to sell the business in X period of time, then that can sometimes impact your ability to maximize proceeds, because you become a seller who needs to sell versus one who's looking for the right purchaser at the highest price. The other thing is to start thinking about, early on, who is most likely to buy the business. Sometimes it's a transition of family members. Sometimes it's a sale to management or employees. That is often those top two are great avenues especially for the small to mid-sized businesses. Because it's, family, obviously there's sort of a connection there, and you can work out something fair for everybody. Management employees, why those are a great source as a potential purchaser is because they are familiar with the business. They at times will regard the overall risk of the business as less than an outside purchaser, because they've been working in the business for a number of years. They have the familiarity potentially with customers, processes, all that other stuff. So that is a great avenue to explore. And then there's sale to third parties. And then just always be open at the end of the day. When selling a business, it's more complicated than selling a home or a piece of real estate. So you got to keep your options open and be flexible. So some of the key planning steps, it's I think important to gain an understanding of a realistic range of your business is worth. You want to consult with your especially the financial planner, to ensure that what you realize from that business plus any other savings, RSPs, all that other stuff are able to meet your retirement needs. Because you don't want to go through the process, find a buyer, get close to sort of getting a deal done, and then realize, oh, wait a minute, that's not enough to provide for the retirement I want. Now I can't sell the business, right? You want to do that planning in advance to make sure. And then also looking at variables, you got to look at, what your base case scenarios, best case, worst case, to be able to be ready for those different items. The other thing I say is, don't check out early. This is, fairly often you get a scenario where a business owner is they get to that point and they're like, okay, I need to sell. I'm just not into it. The sort of day-to-day grind gets to them, and they come to this sort of sudden halt where they've come to a decision that they need out. You want to make sure that you're planning in advance, so that when that time comes, that you're prepared, and you can't check out early. Because the other thing is, you get business owners who have a business and sales have been decreasing 10% a year because they've just had enough. They've decided to mentally check out and all the rest of it. Selling a business with decreasing earnings is far less attractive and profitable than selling a business with steady or increasing earnings, right? So, make sure if you want to maximize proceeds, you got to plan and keep going until such time as you're ready to sell. Other sort of key planning steps, making yourself redundant. Ensure you have detailed and clean financial records. The less adjustments and stuff you have to be showing to potential purchasers, the better and easier that is for them to understand. And it also just increases the sort of faith they have in the numbers. Organized documents, records, contracts. So, there's a number of resources out there, and we'll sort of talk about the BizLink program, and even, some Google searches about getting my business ready. There's sort of some some general items, but the one is like be organized. You know, when you actually are ready to put your business up for sale, you want to know what documents are going to be asked for, and you want to have them ready, because that shows organization. It shows that you're not running, you know, a disorganized process or business. General things are, you know, financial statements for 5 years, tax returns for 5 years, notices of assessment, GST, HST, payroll records, all those financial documents, make sure they're ready to be available and shown. Other things are, you know, if you have client files, all that other stuff, that they're there and ready. Leases, you want to have any leases or any contracts that the business is a party to, whether that's a photocopier, leased premises, vehicle leases if they're going to be transitioned with the business, all those things. You know, any potential purchaser coming in is going to ask for that stuff. You know, go back to the payroll, you want to have all the records on the employees, what you pay them, how long they've been with the organization, that sort of thing. And then document processes, procedures, and methodologies. This sort of goes to the point. The businesses with the greatest value are those that can operate without the owner manager present, or without the owner present. You know, may need a manager, all that stuff. And the more documented those key processes, procedures, and methodologies are, the better, because that means that you can come in, and when you say, oh, how do you do this? Well, we have our operations manual here, and you just turn to page 14. It tells you what we do and how we do it, and that sort of thing. It's more applicable to some businesses, less applicable to others, but in any event, all businesses to some degree should have some process and procedures documented. Yeah, here's just a slide showing some of those items that you want to get ready and prepared. You have 5 years of financials, leases, employment contracts, customer and supplier contracts. Like if you have any contracts with customers or suppliers, you want to have those in ready. Detailed asset listing always is something that you'll need. So you kind of do need to go out and inventory sort of those fixed assets that you'll be selling with the business, whether that's vehicles, you know, desks, computers, all that sort of stuff. You want to have an understanding of what those are exactly, because that's always an item that comes up, and people want to know, what am I getting? You know, how many computers, how many desks, how many chairs, that sort of thing. Tools, all those items. Sorry, excuse me. Any outstanding or prior lawsuits. When you do sell a business, it'll be subject to a legal review. So, you know, it is better, in my mind, always to be transparent with those items. So the biggest thing one of the things that can definitely kill deals are when there's surprises near the close. You could get close to selling business. Oh, wait, we forgot to tell you that we're, you know, engaged in a lawsuit. Well, that shoots out credibility. It creates additional risk to the purchasers, and they can decide to walk. So if those items are present, you want to be able to disclose those in advance. Also, consulting with your lawyers, accountants in advance to say, look, I'm going to be selling. Is there anything I need to do? Often there's like tax planning and other stuff that can be done, or at least you just want your advisors to know that that's what you're thinking, just in case they have any tips. If there is anything you need to get cleaned up from an accounting or legal standpoint, that sort of thing. Yeah, so tips for maximizing value: make yourself redundant. Yeah, a lot of the other same things there. Another item, like hire your purchaser. At times, that's a way to maximize value. As I sort of said, a manager, an employee, sometimes if you've been working in the business for a year, you get to understand it, you get to understand the clients, all that other stuff. So it is a strategy for certain businesses to hire that purchaser. Even if you find a purchaser and he says, yeah, maybe he works for a competitor, maybe he's doing the business in another geographic area and is looking to move to your area. You know, you can hire them, they get to know the business, all that other stuff, and come up with a plan for transition. The other item is vendor take back. So if you hear the term VTB or vendor take back, generally, I would say 90% of say small to mid-size and even large business sales have some aspect of a vendor take back note. So what that is if you agree to sell the business for $100, you may agree to say $50 or $75 cash on closing, and you take a vendor take back note or a piece of debt for the rest of it. So that is, you know, in the case of say $100 sale, you get 75 in cash, and you have $25 that you are holding that the purchaser will pay you over time. Now you get generally, you will get say quarterly, monthly, quarterly, annual payments on that vendor take back note. It'll be repayable over anywhere from 1 to 5 years. And you'll generally get interest paid on that. So they say, okay, I'm going to pay you 75 now, I'll pay you the 25 over the next 2 years in quarterly installments and X% of interest. Why that allows you to maximize the value of the business is you are sharing in the risk. You are showing confidence in the business that it will succeed and that it will keep earning the money it is. And that's why you're able to sort of maximize the value, because you're willing to sort of be a participant there. And then your objectives, being repaid the vendor take back note, and the purchaser's objective of succeeding are aligned. You know, if the business is going to succeed post transition, it's going to pay you back the money, and they're going to get the business that they think they're getting. You know, there are ins and outs to that. You'll get counsel on that from accountants, lawyers at the time, because you are, you know, you're then a debtor of the business, and you need to be confident that that operator, because you're taking like now operational risk, you're saying you're going to pay me this amount back, but you're showing faith in them that they're going to be able to do it, and you need to be confident that they are going to be able to repay you that amount. Keep investing in the business. You can't let it die. You know, like you have to, you know, someone is buying, you know, there's certain cases where some people start investing in the business to make sure it's going to keep on generating those future revenues. If you don't continue to maintain that business, it's just the same thing as checking out early. You can't check out early. You got to keep it running as it was. Keep your employees engaged. And your human resource capital high. So that just like, there's many businesses that a key aspect of the value is the employees you have. An excellent example is say like a electrical contractor. Electricians are hard to come by. If you have a staff of 5 electricians or 10 electricians, that is a huge benefit to a potential purchaser. And one of the reasons those purchasers will want to acquire you is because they instantly get access to a set of qualified electricians, which are, again, hard to come by, hard to train, find, all that sort of stuff. You know, again, comes to this whole planning ahead. You want to identify any efficiencies that you can cure in order to get those earnings up and all that other stuff. Contract business increases value, not applicable to all, but in general, if your clients have a contract, if they can be contracted, then, you know, for the provision of services, those do increase value. Okay, so then we'll go on to tax planning. So when selling a business, if it's incorporated, you have the choice to either sell assets or shares. Purchasers prefer to purchase the assets. Sellers prefer to sell shares. Purchasers prefer to buy assets because it reduces the exposure to liability. When you buy shares in a company, all past liabilities that corporation come over to the purchaser. They stay with the corporation and therefore with the purchaser. And that's where I go to. That includes like if a corporation was deducting a lot of personal expenses for many years, then you sell that corporation, that potential liability of CRA reassessing that company stays with the company, not with the shareholders. In general terms, there are some asterisks to that. And that's why there are certain businesses where you cannot sell the shares. You know, a business that is involved in, say, like environmentally sensitive things, or is just naturally attracts a certain amount of liability. You know, accountants are an example of that. We in theory expose ourselves to liability as a general part of our practice, and we generally, accountants do not sell shares. just because they don't want to go through the bother of potentially getting those past liabilities and that sort of thing. As well, purchasers get a bump on the fair market on the asset. So if you are buying, say you have a manufacturing company had $1 million of equipment that was depreciated to $100. If you buy the shares, you only have that $100 base to depreciate against future earnings and save taxes. If you buy the assets, you get to bump it up to that $1 million value and then get to depreciate that. So there's sort of a tax savings there. And often there's a mechanism you can actually calculate what the value of that tax savings is, and it becomes a just negotiating point. As far as sellers go, they basically want to sell the shares for the opposite reason the purchaser want to buy the assets. Tax savings for them on the sale of shares because they may be able to access the QSBC capital gains exemption. And it reduces their exposure to future liability. But in general, you just look at the business. Most of the times, as long as there's not a huge liability issue, you can generally negotiate the purchase of the shares to somewhat appease both the seller and the purchaser. Qualified small business. So every individual is eligible for the capital gains that has a one-time lifetime capital gains exemption on the sale of qualified small business corporation shares. That's a bit of a mouthful. The current capital gain lifetime capital gains exemption on QSBC shares is $913,000. It's constantly moving. It increases by inflation every year. It does require some planning, generally a few years in advance because of the requirements. It basically has to be owned, a Canadian company owned by Canadians, operating an active business. Certain percentage of the assets must be used in the active business and other things. So that's being where if a company has accumulated a lot of excess savings in it, those need to be taken out prior to the sale. So that's where I say you got to let your accountants know well in advance because there are certain time restrictions and rules revolving around these things. There also are opportunities in certain instances if you have a sole proprietorship to roll your assets into a corporation tax-free and then sell the shares of that company. So yeah, a variety of things. Again, just communicate with your accountant if that's what you're thinking about doing so that they can give you the proper advice or put you in touch with someone to do so. There is a new Bill C-208, I forget when it passed exactly, sometime in the last year or so, which does allow for the realization in certain circumstances of this capital gains exemption on the sale to family members. Before that was prohibited, but that's been a new thing to allow for sort of the equalization of the playing field. Again, another thing, it has to meet certain criteria, be done in a certain way, but can be done when you pass it on, say, to your kids to realize that exemption. Yeah, so the sort of general considerations are Canadian controlled, all the fair market value used in the active business and held for 24 months prior to the sale. All these things are subject to little exceptions and all the rest of it. But again, that just goes to the point of making sure to communicate with your advisors in advance to make sure you're doing everything you can. Yeah, and then so final notes, just be organized. Realize that a business's value is subjective. What you may perceive of as value may not be what the market perceives, or it may be, or it may not be what the seller perceives. So there's greater variation in the assessment of value, being that, you know, you may assess the value of your business at $1 million and you may be right. And then a purchaser may have something that's far different than that. It is more subjective. And that's the bottom line. It's just not like selling a house. There's a greater variance there. You know, selling a house, again, that example, you could look to the 5 neighbors, what they've sold, that's easy. Businesses are just a bit more subjective and that way. As well, you know, like emotion comes into it, and just remember it's not personal. And yeah, so sales are still happening. The market's, you know, it seems like there's still a fairly active market for business transitions. You know, we're going through some economic hiccups at the moment, potentially, you know, with interest rates changing and all the rest of it. That's fairly new in the last 3 months, so I haven't really seen anything that's changed all that much, but it may, you never know at the end of the day. Okay, so that's basically it. And I don't know, Carol, if you can hop on and maybe see what questions we have.
Oh, okay, perfect.
There
So
we go.
I don't know if everyone was able to see a frozen shot of me up in the corner there throughout that whole presentation. Thankfully, I wasn't doing anything like adjusting my hair or anything equally embarrassing, but you didn't find that distracting, I hope. We have had a number of questions. Thank you, David, for that presentation. I think if one theme comes through, it's that there are many things that you need to know when you're looking at selling a business or buying a business. Assembling a team of professionals that can assist you with that is certainly critical to this. As I mentioned, we did have a lot of questions submitted ahead of time, and there's a couple in the chat. So I'm going to start with the ones that we have in the chat. There is a question about multiples. So I wonder if there's a sort of just a practical example that you could share, David, of how you would apply a multiple to a business in a particular sector.
As in, like, I guess the closest one to home is an accounting practice, I guess. You know, like generally accounting practices sell at about 1x revenue. And it's a good but bad example, because generally I don't like to use any sort of revenue multiples, because you want to look at the cash flow it's earning. And that usually comes down to like 3.5 to 4x EBITDA. So I don't know if that sort of answer, like different industries will have different multiples. There's sort of how I determine that. How do I assess that? I have access to a few databases, which you can sort of do comparatives on. You can try and pull transactions for the last 5 years. Those databases are generally assembled by business brokers. It's a company that aggregates information from a bunch of brokers across North America and internationally. Again, I'm just generally trying to concentrate on Canadian or North American examples. So that's where I sort of pull that. You can pull it by industry code. So if you're, you know, a sheet metal manufacturer, you can pull up theoretically examples of similar businesses to try and get that. And sometimes examples don't exist, and that's why there's a lot of judgment and that sort of thing. So that's why you kind of, there's other methodologies that we go through to sort of compare the potential target business to what is, you know, that's what an investor is always doing, is trying to determine, I can buy, you know, they're making a decision. Do I buy this business, or do I potentially just go invest in the stock market? You know, and that sort of goes to how that risk and multiple is determined. As they say, you know, you could go buy, you know, Rogers Communications, and that'll give you an X% return. You know, they're going to want generally a greater return on a private business and that sort of thing. So that's where you know, sometimes you can compare to actual transactions. Other times you have to use sort of more subjective methodologies, we'll say.
Okay. Another question I think is pretty close to home, as far as, you know, the pandemic that we've all been working through over the last couple of years, is, you know, how does that interruption of revenue off and on, just what's gone on with businesses, how is that generally factoring into business valuations these days? You mentioned, you know, 5-year financials. Are the most recent couple of years of financials being treated differently generally, or how do we factor that in?
Yeah, it's a good question, and without a solid answer, I'll put it that way. It really varies by business. There's some businesses that, in general, like, you know, there's some businesses that have done worse. There's some businesses that have done better. There are some businesses that have been even. Obviously, that's the whole gamut. At the end of the day, a lot of businesses have done better. Sometimes that's due to government funding, sometimes not. You have to look at the specifics, because I've done valuations for certain businesses where they've, say, received that uptick, and that's expected to continue. It's kind of been a permanent shift in behavior or consumer patterns, and therefore you are looking to even those healthy COVID years. There's other businesses where that's sort of a one-time blip. I'm trying to think, like, some of that stay-at-home economy type of stuff where some of that will be normalized in the future. Of course, in Ontario and Canada, the housing and construction is such a big part of our economy, and it's hard to say where that's going to go at the end of the day. So it's really varied. And the other aspect to that is there's been government subsidies. There's a lot of businesses who have shown greater income than past. So you need to really look to, whether that government subsidy was 100% of just a one-time boon. So we would normalize for that. Generally, that's what we're doing, is we're normalizing for those government subsidies. There's other businesses where that government subsidy was just basically filling in gaps appropriately where they otherwise would have been customers. So again, just, I was looking at a business the other day, and it was one of the ones, like say a restaurant, that type of thing, where they were actually forced to close at certain periods of time. I'd really want to be doing like a monthly analysis of those revenues to isolate those closed periods and that sort of thing. And you're really at that point trying to just plot out what the next year or two looks like now that you've recovered to, say, being open all the time and no seating restrictions and all the other stuff that those businesses went through.
Mm-hmm. I really like the way you put that about that the assistance is filling in a natural gap that was created by an interruption in business. It's not something that the business would have needed otherwise. So
right. And it was just bringing it back to the normalized state, right?
Mm-hmm.
And so that's where I think, even especially now, if you're in one of those businesses where you might have received, closures, all that other stuff, you really got to start. That's the importance of sort of planning and trying to create some forecasts of what the next 12 months look like.
Mm-hmm. Perfect. I'm going to read a question that's in the chat just to make sure I get the wording correct. It says, if I sold an asset of my business in the past and installment payments are scheduled to continue after the business sale date, should that be pulled out of the books and resolved separately and not factored as a revenue stream?
If I understand that correctly, if you're saying, if I understand that correctly, so if the business had X asset and it was sold and it created, a big capital gain on the income statement, generally we would normalize for that because that's a one-time non-reoccurring item. Generally, even those capital, even like both the purchase and sale of those capital assets, we usually try and look differently than the actual operations of the business. So that's where we sort of distinguish between operating income and sort of the capital expenditure side. So in general, we're trying to look, when we value a business, you look at those sort of operating earnings, and then you normalize for both capital expenditures and expense items. And you want to get to what is the steady state, like on average over the past 5 or 7 years, how much does that business need to expend on capital items? Because that affects the eventual future cash flows that the purchaser is going to earn, right? You may only buy something every 3rd year, so you kind of just try and smooth that out.
So really concentrate on what are the ongoing normal expenses and income of the business, as opposed to what, like you termed it, one time influxes of cash or expenses.
Yeah, exactly.
So this is a question. I know it's always a question, but what would the range of cost be for a business owner looking to get a certified business valuation done? And is that even a question that can be answered?
I can broadly answer. So like that can cost anywhere from, give or take, $4,000 to much more, $10,000, $20,000. Depends on what you're using it for and the size and scope of the business. Generally what, when I'm giving, say, like in general, when I provide these services, there's a few different reports that I can prepare, and they are ranging from cheaper to more expensive naturally. And, if I can see financial statements for a few years, then usually myself or any other business valuator will be able to offer a sort of approximate quote for what the service will provide. Certain things can affect that, like the complexity of the business, the state, how organized the books and records are, whether or not they're prepared, whether they're notice to reader sometime in reviews, depending if it's designated accountant, that sort of things, what's on the balance sheet, how many owners there are, the purpose, they all sort of go into what that is. So yeah, but just broadly, most of the work that I do is, for a single business is somewhere in between $4,000 to $5,000 to 10 to 12, again, depending on needs and size and all the rest of it.
Okay, I think that gives us a pretty good idea. There's another question here, which is kind of interesting. It's saying, how do you include consideration of investment and equity sharing with employees? So I'm assuming that means, and whoever asked this question, if you'd like to correct me, please do. But if you already have a sharing arrangement with your employees, how does that factor into the value of the business?
I guess if I understand it correctly from two perspectives, like if you're saying some businesses will give employees bonuses based on financial performance.
Mm-hmm.
So if that's sort of the equity sharing, then we just want to know whether that's just getting the employees to what is an economic compensation amount or not. If they're getting additional amounts based on actual share equity held, then that is the same as like a related party. You just want to normalize to what someone will need going forward. The third aspect of that could be at times someone may own 75% of the business, but then have some employees or key people owning the other 25%, and how that impacts the actual value of the business can range wildly. Like it doesn't change the on block, the 100% value of the business, but it may, depending on shareholders agreements and rights of those minority shareholders, it could potentially impact how you're able to sell it or not. Right. So that's just one of the things, there's a difference between sometimes if 100% of a business owned by one person is worth $100, if you only own 5% of that, there's usually things that are called sort of minority and illiquidity discounts that are applied because to reflect the fact that that person who only owns 5% can't control the cash flows, the management generally is restricted about how they can sell shares and that sort of thing. And that would go for someone who owns 50 or 75%. You just have to assess what their ownership rights and what their ability is to sell it. A lot of times when you have a majority shareholder, they will have tag along, drag along rights so that they can sell the business, and those minority shareholders are obligated to sell at the same price. So.
Tag along, drag along rights. I like that.
Yeah.
There's another question here, and I'm not sure if it's appropriate for David, although I'm sure that you've seen examples of this and can help with the answer. It's really just what are the best mediums for letting potential buyers know that you want to sell your business. So, I mean, I may just sort of jump in real quick before David takes over. I think one of the things that it's important for a seller to do is identify their confidentiality level. So at the current point that you decide you want to sell your business, who are you comfortable with letting know that you want to sell your business? And that will determine the medium that you use to advertise that your business is for sale or to communicate with potential buyers. So an example of that would be that, if you want it to be completely confidential, maybe some colleagues or suppliers or employees, they may be sort of your first rung of potential buyers. You would quietly communicate with them. And then as you expand your sort of confidentiality, as you loosen up the confidentiality, then you can put the word out there more broadly in terms of, a public listing or what have you. So, David, did you want to pick up on that?
Yeah, that's right. It depends how, at the end of the day, greater exposure is better, but it's not always practical for all businesses due to those, sometimes if your business is known to be for sale, it can be detrimental because you might have a business where the clients that would scare them off, and therefore they're going to start looking for someone else because they're uncertain about this transition type of thing. Other businesses, it doesn't matter. So as far as like the avenues, like your BizLink program, determining your comfortability, like there are, you can list it on realtor.ca through an agent. You can get a listing that way. You can approach various business brokers, and they will assess and try and determine. Sometimes you're doing a targeted approach where you say, I don't want to expose it to everybody, but here are 5 individuals that I think would be interested, right? And sometimes that's because of competitors are often an excellent avenue to approach, and that sort of thing. And then you just have to be careful as you're going through that process to make sure you have the proper non-disclosure agreements and that your business is not going to be compromised by sharing information.
One other question that I have here as well is we talked about service-based businesses, and I think this also deals with a couple of other questions here regarding, what do you do when you're the face of your business, when you feel like you are the business? How do you go about building that business over a period of time, say 10 years plus is the example given, to actually make it saleable? Like, what kind of steps can you take, things that you can put into place to make sure that you have a business that will continue on after you extract yourself from it?
Yeah, there's no easy solution. Like, so at times in business valuation, we can, there's certain businesses that have what are called key person discounts because they're so reliant on that individual that it actually does impair the value. So it depends your relationship with the clients, all that other stuff. That's where sometimes hiring your potential purchasers is beneficial. Sometimes, and this goes for, I'll just lump myself in there, accountants sometimes think they're more important than they are. And that a lot of businesses, I've had conversations the odd time with business owners who I think are overemphasizing their importance to the business. And a lot of times, if you're providing good service to, say, a set of clients, you no doubt will need to take time to transition that relationship. But that is sometimes, like, if you find the right person and you feel that they feel and you feel that they can take over and deliver the same service, then you can go through that gradual transition process where you may need to stay on for 3 months, 6 months, a year to sort of to make sure that new purchaser is giving the same level of service and that the customers are comfortable with them. But there's a lot of businesses where the customers will give the new purchaser the chance to fail, as in, just using that accounting example, we've found, because we've, over the number of years, I think we've had, 15 years, we've sort of brought in 2 other practices. And we've found that those clients were very much, most of them were give us the chance to succeed at the end of the day. They were happy, the existing client introduced us, participated in that first meeting and that sort of thing. So I think that's the type of angle you have to look at in that scenario to transition that business, is you got to just make sure you're making the right introductions, that you have the right purchaser, and both parties are aware of, like, this is the level of standard of service that they were used to, and if you want to keep them, this is what you're going to have to provide them. So.
And I would think that, as a lot of business owners do, they have personal relationships with their key clients. So if somehow that can be formalized, as you said, in terms of some sort of a contract that could then be passed on, or at least highlighted during the valuation or the sale of the business, that would be helpful.
Yeah, and it's definitely, like I said, that's an ideal scenario. Not always practical and all. Like, just again, I'll just go back to the account scenario. Like, we don't have contracts where clients are obligated to return to us year after year after year.
Right.
Just is what it is.
Yeah. So another question that's fairly specific to an industry, it says the childcare operators are beginning to receive more government funding through the National Child Care Plan. They have brought forward concerns about how this government funding may impact the value of their business when they sell at a later date. Is that something that you've heard anything about or can offer any information on?
I cannot. I do know that this is occurring, but I don't know what the impact has really been as you go through this transition, because I don't even, yeah, I'm not sure about what that new model, like I know the just general, whatever it is, this $10, $20 a day care, and I assume that the government's coming in to supplement the rest of it. And is that going to be more or less profitable to an individual daycare operator is probably the concern. And yeah, it's, I think that's kind of a bit of unknown at the moment. I definitely don't know the particulars of it at this time.
Okay, great. One more question, and then I think what I'll do is I'll just give people, it looks like we've handled, I believe, the questions that are in the chat. If somehow we've missed something that has been put in there, if you want to just sort of draw my attention to it or throw it in again, that would be great. The last question that I have here that I don't think we've addressed is, can a business be sold with an outstanding HST balance, or does it need to be caught up before the sale?
Generally, you'd want that caught up. So I take it this might be like on a given closing date, if you close on December 31st, generally that company has an HST liability for that past month or quarter, which is normal. What you don't want is like arrears and all that other stuff. And the reason why, especially with HST, same with payroll source deductions, are an issue is because those liabilities extend beyond the corporation to the shareholder. So if I'm looking at potentially purchasing a company, that's one of the first things that gets asked is like, show us your HST records and your payroll records so that we know that everything is up to date and there's nothing outstanding. So it is possible. I'm not saying it's not possible, but you know, at the end of the day, it should be cleared, you know, relatively, generally speaking, should be cleared up. And that sort of also goes to like, if it is just for that last month or quarter, that's just part of the working capital calculation where you just say, you know, your receivables are going to offset those payables, one of which is HST. So.
Question about a merger is, in the case of a merger, is it 50-50 or 49-51 or other variables in addition to that?
Lots of variables. I mean, that all depends on the given situation, right? Like, so if there were two companies coming together, then they got to determine what is the value of company A and company B to be able to determine that. And that's just ultimately a negotiating thing. Yeah. So highly variable. Okay,
perfect. So that, I believe, are most of the questions that we've had ahead of time. I can ask Johanna if she has any other questions that she's received that she might want to pose. I think we've got everything that was in the chat. Looks like it. So I would like to actually thank David very much for this information. As he stated in the presentation, you know, business transitions are happening, business sales are happening. It's something that as a business owner, you want to start preparing for the sale of your business as soon as you start it, which seems like an odd concept, but if you think of it that way, that you're starting this business to last and you're making an investment in it so that it is worth something, and look at it through that lens, that is, you know, probably good advice. I would like to just take a moment. We've mentioned BizLink a couple of times, and maybe I'll just take a second to let people know what that is. Regionally, and this is a county presentation, so regionally, the CFDC offices, Nottawasaga, North Simcoe Community Futures, the South Georgian Bay Center for Business, and also or Community Futures of South Georgian Bay, and our CDC. We have a program that is called BizLink, and it's a business transition program. So the purpose of the program is to provide resources to buyers and sellers and to connect buyers and sellers. So a lot of the questions that have been asked here in terms of, how do I prepare? What kind of information do I need to have? That sort of thing. Johanna will be giving a link to so that you can connect with your local CFTC office. And there are resources that we can provide you with that will help you navigate through this process, checklists, that sort of thing. Also, again, very important to connect with professional advisors. One person can't know everything about everything. So to be able to make sure that you connect with people who are experts or professionals in whatever the legal or accounting or what have you aspect of selling a business or buying a business is. So I think that really brings us to the end of our presentation. I have been asked about the slides being available. They definitely will be available. We will have a link to the recording. It has been, the presentation has been recorded. So if there's anything that you've missed, we also would be happy to answer questions if something occurs to you and it was not answered. During the presentation, we welcome your questions and we'll try to get back to you. Just in closing, I again want to thank the county for providing all these opportunities for training through the Ask an Expert program. And I especially want to thank all of you for attending. It's this kind of interest that you show in the strength of your business and the topics that we offer around the growth and development of your business that makes these presentations possible and valuable. A survey is going to be sent by email to each of you, and I highly encourage you. I know the last thing we all need is another survey, but if you would please take a few moments to complete that survey. Let us know if the presentation was valuable, any suggestions for future presentations. Just let us know how we're doing. And you can actually find more information on the Ask an Expert series at simcoe.ca/Ask an Expert. So again, I'd like to thank my sponsors. Thank you all for your time, and thank our presenter. And we'll see you at future.
You're very welcome, and thanks everyone for joining.
Thank you.